read 70 pages, when you read the standard, 70 pages standard, divided into 5 sections with 7 appendices, you get overwhelmed with so much information that you lose sight of the forest for the trees. I think this is the phrase you use. You basically miss out the big picture. So I'll give you the big picture right now, and hopefully when we are talking about the nitty-gritties and the details, you will be able to fix those details in the big picture, like a jigsaw puzzle. So first of all, this standard establishes 11 core governance principles, and we are going to discuss what those principles are. Then it also identifies the organs who are going to be responsible for the governance and management of investment accounts. Okay, because if you have an Islamic bank, 500 people working in it, are all those 500 people going to be responsible for managing investment accounts? No, there has to be specific organs. So the standard identifies very clearly who the organs of the management of investment accounts. Then it assigns roles and responsibilities to them. And you know what happens when you assign a responsibility to somebody? Yes, exactly. Then you hold them accountable for it. You cannot hold anybody accountable without assigning responsibility. So the standard clearly defines this is what you are responsible for, so that you can be held accountable. So if anything goes wrong on the investment account side, we know who to catch. This standard also talks about a very important document. It's called, what AAOIFI calls it, you can call it by any name. It's called Investment Account Strategy and Policy Framework. And there's a whole section on this. And the standard is saying that if you are an institution offering investment accounts, you cannot solicit money, you cannot go out in the public and get money until and unless one of the things that you must have in place is this document. If you don't prepare this document, you are not allowed to go out there in the public and get money. So obviously this document is very important. Now, if I have an institution, what I'll do to comply with the requirement of this requirement, you tell me what I should do. No, I know that I need to adopt this requirement. I need to implement this requirement. Now, as an institution, how can I adopt and implement this requirement? No, think from an evil perspective. I'm an evil person. I'm not a moral person. Think from the evil perspective. The shortcut. What is the easiest way, the cheapest way, the fastest way to get this to be compliant with this requirement? Sorry? Not really, no. You're right, but I'm looking for a different answer. A sinister answer.
Finding the loopholes in that.
No. I don't have the patience to do all the research to find loopholes and everything. I want to get this done quickly. I'm compliant with this requirement.
Write everything in a couple before.
Sorry?
Write everything in a couple.
No, we'll come to that. You know what I'll do is, I just prepare a 2-page flyer, investment account, strategy and policy framework, and say, look, this is the document you were asking. 2 lines here, 2 lines here, 2 lines here. Assalamu alaikum wa rahmatullahi wa barakatuh. I'm in compliant. So we foresee this situation. That's why in the standard we identify, I think how many? 15 components or sections of this standard that you need to produce in your document. And in those 15 components, we also identify the minimum things or the considerations that you must cover. So it's not like you put in the heading component 1 and you leave like you can write anything there and you're good to go. No, you have to cover specific points. Fair enough. But okay, fair enough. So the standard actually tells you that this is a document that you need to prepare. In this document, there are going to be 15 sections or components. And in each of these components, you are going to address this point, this point, this point, this point, this point. So this is the document that you must have if you are an institution offering investment accounts and going out in the public to get. Now, is this enough? Not really. Even after you have this document and you implement this document, still not enough. The standard says that you need to do two more things. You need to have competent, skilled human resource. And obviously it's talking about with respect to governing and managing investment accounts. You need to have human resource. And second thing, you need to have the IT infrastructure in place. Because this is a very complex and technical area. The profit and loss distribution, attribution, and computation is very technical. You require systems to produce it for you. So you need to have these two things, the HR and the IT in place before you go out in the market. So if you adopt this standard, you can clearly see the kind of work that you have to do at your end. Okay. Another thing it talks about is the stage when you're signing the contract with a potential investor. Now, what are the requirements when you are at that stage? So the standard basically says that you need to prepare contracts according to the requirements. You need to have a contract having minimum. Okay, let me rephrase this. What it's saying is that when you are at the stage of signing, or before the stage of signing a contract with a potential investor that you're going to get money and invest in everything, you need to have one more document in place. And in this document, the standard tells you you're going to cover this point. And this includes various things like PSR, weightages. It talks about how your money is going to be invested. What you were talking about, basically transparency and disclosure requirements. You need to have this embedded in the contract that you're going to sign with the investor so that he has full and proper information when he's making a decision. And this is going to be different for two different types of accounts. Like we have in this standard, we have low risk investment accounts and high risk investment accounts, LRIA and HRIA. And this standard is actually encouraging institutions to promote HRIA, high risk investment accounts. We feel that this is much more closer to the true spirit of Islamic banking. Because what is Islamic banking is that you get money, you invest, and from the investment returns, you share it with the investors. With low risk investment accounts, it's more like safekeeping. You deposit your funds, and yes, you can use it for investment purposes, but then you withdraw it after every 2 days, 3 days, 4 days, and then you add it. So it's more like a current account acting as an investment account. So LRIA, low risk investment accounts, is not something which is closer to the spirit of Islamic banking. HRIA. So the contracts for these two different types of accounts has to be amended accordingly or produced accordingly. Now, this standard also talks about the PLC period, profit and loss computation period. What are you supposed to do before this period? What are you supposed to do during this period? And what are you supposed to do at the end of the period? This is like the minimum requirements set forth by the standards, and we are going to cover this inshallah. If we have the energy left, I can already feel that you are drained completely, you're exhausted, mentally completely exhausted. No, I will just wait for the standard to start. Anyway. Then this standard also talks about issues related to redemption of your investment.
Let me know when you want to change the slide.
Sorry?
Let me know.
We haven't started the standard.
Okay.
So I'll let you know. Now, redemption again could be during the period, PLC period, or at the end of the period. So there are different requirements that the institution needs to follow. Another important issue covered in the standard are the considerations in the event of liquidation of the institution. What happens when the institution is liquidated from the governance perspective pertaining to a very important topic of investment accounts. What will happen to investment account holders in the event of liquidation? So this is in a nutshell the areas where the standard is going to provide you with some guidance. And I can assure you, there is no Islamic bank in the world right now, as of right now, which can fulfill maybe even 35% of the requirements of the standard. I'm again not saying because of malintention or because of malpractices. It's because you don't have the guidance, you don't know what to do. So everybody's trying to figure out. So as Brother Siddiq was telling that we have the standard setting process, we established this working group. In this working group, we have people from different parts of the world, Sharia scholars, regulators, accountants, practitioners, consultants, all of these, they chip in with their knowledge, their experience, their insights on investment accounts. And then we develop the standard. So this is the product of like hundreds of hours spent researching and talking to people and trying to understand what the core issues are in different markets. Anyway, so we start with the standard, inshallah, in the name of Allah subhanahu wa ta'ala, the objectives part.
گلدن سنگ نیست چرک است به جای میکشی چای میخورید؟ گلده باشه دیگه شد یکن دقیقه گفتم شب بسیار با تکلیف گفتم زنگ میزدی با ما خیلی پیش دکتر میبودم همین طرف
They don't want me to start actually.
بودی سنگی طرف دیگه کش خلا بیا باز بسیار با تکلیف دچیام نرفت بسیارینام نرفت
Okay, I repeat myself. If you feel when I'm discussing a paragraph, an important point is missing in the standard, please let me know. Okay, you can stop me and you can add your point. Okay, over here, maybe you need to add this. Over here, you need to say this differently. Or maybe over here we have no idea what you're saying. So all of these comments will take to the respective working group. You just saw Miss Zahra Jasim. She's the head of governance. And she will escalate it to the working group. And it's their job. They will handle the comments that you're going to give. It's not going to be my job. So alhamdulillah, feel free to give as many comments as you like. Okay, don't hold yourselves back. Can we start now? Next slide. Next slide. Brother Siddiq.
Okay,
If you can ask him to run the slide, that would be
it's
better,
been
actually, because he knows.
yeah, the slide is done.
Paragraph 1 and 2, okay.
This one is fine.
So yeah, this is okay. We're talking about paragraph 1 and 2. And the question that we are addressing in these paragraphs is what is the purpose or the goals or the aims of developing this standard? So number one is we want to improve Sharia compliance in respect of investment accounts. So I'll just give you an idea of how this public hearing works. When I was reading the standard, I realized that it's talking about Sharia compliance, but what about ethical compliance? I know ethics is part of Sharia, but it needs to be clearly differentiated. So one of the objectives of this standard is to improve Sharia compliance. Do you think one of the objectives of this standard could be to also improve ethical compliance? So if yes, then we need to add this comment and take it to the working group, and they will decide and they will say, actually, this standard is not talking about ethics at all. So why should we make this as an objective of the standard? And they will remove the comment. So I'm just giving you a simulation of how things work, okay? So this is the first objective. We want to improve Sharia compliance. I've given you so many reasons where the issues are. So we need to improve Sharia compliance. We need to improve risk management mechanism for investment account holders. We need to enhance trust and confidence of public at large. Another objective of this standard is to protect against reputational risk, promote better governance structures, and last but one of the most important objective of this standard is to promote high risk investment accounts. Okay, so these are the objectives. If you want to, say something, have your comment on this, please let me know. Now, what is the scope of the standard? And the question is, on which type of products this standard will be applicable on? Okay, so scope and in the scope and out of scope is very important part of the standard, because you need to know that the requirements of this standard actually applies on X, Y, Z things and not on A, B, C. So here in the standard, we are saying that all participatory investment instruments issued by an Islamic financial institution. We give examples like investment accounts based on Muzarba, Musharka that represent quasi-equity. They will be included as part of the scope of the standard. Wakala bil istismar when it is co-mingled with urea. You know what urea is? Unrestricted investment accounts. So when Wakala funds are, Wakala bil istismar funds are co-mingled with unrestricted investment account funds. Then we have like investment instruments offered by the Takaful operators if they are qualified as quasi-equity, off balance sheet under management like RIA. You know what RIA is? Restricted investment accounts. And Wakala bil istismar when it is recognized as off balance sheet. So this standard will be applicable on those as well. And Sukuk, which are based on participatory structure, we have seen some tier one Sukuk part of investment pools. So the requirements of this standard is going to be applicable on such structures as well. Then the PIA in Takaful. Does anybody know what PIA or PIF or PIA? What it stands for? In Takaful, is there anybody representing Takaful industry, by the way? Is there a Takaful industry in Afghanistan? I think that's the first question I need to ask. Inshallah, of course. So, Takaful operators, they have two accounts. The PIA, which is Participants Investment Account, and PRA, Participants Risk Account, something like this. PRA and PIA. So one of the account is used for takaful purposes, the protection against death, disability, and so on and so forth. And the other is to generate investment returns. So this standard will be applicable on PIA as well, if it is classified as quasi-equity. Again, if you feel there are any other instruments, yes, please.
Then we in the objective section fair and equity distribution.
Very good, yes. Brother Siddiq, can I just confirm with you that the team in Bahrain is noting down?
Yes, they
Yes.
are online.
And they're also recording this session,
Yes.
right? So, okay. So his question is that we need to include another objective, which is fair and equitable, transparent and timely profit sharing with investment account holders. Yeah.
Right.
Okay.
Noted.
It's a very good question, and you will see this, you will come across in the standard, in all the AAOIFI standards. We define very broad level, and then we give the authority to the regulatory and supervisory authority to define it for their respective jurisdiction. Okay, so this is the responsibility of DAP to define what is fair and equitable and everything. Having said that, if you implement all the requirements of the standard, then it automatically means that you are fair and equitable. So the requirements itself is objectively telling you this is how you can be fair and equitable if you implement these standards. Anyway, scope we have covered, which is paragraph 3 and 4. Now coming to the definitions, now these definitions are coming from financial accounting standards and governance standards, so I'll not go through this. I'm going to skip this entire section altogether. We can discuss the definitions when we go there, when we actually come across the term being used. Part A, now this is, like I said, one of the most important part of the standard. It defines the core principles of governance of investment accounts. Now there are 11 core principles. 6A is Sharia compliance. So obviously, the institution must have in place a robust Sharia governance structure. Yes, please. Weightages, definition? Yeah, please go ahead. Do we have a mic, please, by the way?
Yes.
Yeah, so that I don't have to repeat your comments every time. If they use the mic, then the team in Bahrain, they will come to know about it.
Assalamu alaikum wa rahmatullah. Wages are generally only for profit distribution among the depositors of investment account holders. Wages are not used between the institution and the investment account holders. So we know that in Sharia, we can only agree on profit distribution. There is no agreement on loss distribution. Loss is determined by Allah subhanahu wa ta'ala. It should be as per your participation investment account. So here is mentioned that the agreed wages applied as per agreed profit and loss. So it should be written that there should be only agreed profit. There is no need of agreed profit or.
Got it, got it.
Yes.
I think the problem arises because there's a mixture of Sharaka and Mudar. Both are put together. Because these two are different. When you come to Mudaraba, all the losses are transferred to Rabal Mal. When it comes to Musharaka, then there's a profit loss share.
Yes.
So you put all of them together.
Fair enough. We'll take it to the respective working group.
So the question is on agreed profit and loss sharing. There is no
Noted.
need of agreed for loss sharing.
Noted, noted, noted.
Yes. Yes. And the second one, we know that the objective of this standard is to have fair and equitable profit distribution.
Yes, yes.
It's not only between the institution and the depositors. Fair and equitable profit distribution shall be among the depositors also.
Yes, yes.
The weightages are the tools that we may give high weightages for a customer,
Very true.
and low weightages for a customer that is not for general account holders, for example. So how can we ensure this fairness and equitability by using weightages?
Okay. Yes. Brother Siddiq, can you please confirm with Zaha that she's actually able to hear? She's able to hear, right?
Hearing.
Yeah, okay. Because you don't want a situation where we get all the feedback here, but nothing goes in Bahrain, so we lose every day.
We know that assigning weightages are generally based on management discretion. So management give high weightages to the customer that have high deposits.
And the time also, how much time they.
Yes, there are 3 or 4 factors, but one of the most important factors is the discretion of the management. We know that in practice, these practices are in Islamic makings.
Okay, we will move on.
Yes, yes.
Okay. So we were talking about the core principle 6B is fairness. Institution must treat all stakeholders fairly, equitably, and justly. So this is one of the core principles pertaining to investment accounts. Fiduciary responsibility already discussed. They must appropriately discharge their fiduciary responsibilities. That is, they must safeguard the best interest of all investment account holders. 6D is accountability. Brother Siddiq, actually, it's not being matched with what I'm saying on the screen. So this is being recorded for YouTube also. So what I'm saying is not reflected on the screen. So it might have problem.
So which one you want?
6D right now.
60.
So this talks about the accountability part. 6D is accountability. Now, again, when I was reading the standard, I thought, we have 6H also, which is talking about responsibility. So maybe responsibility can be the first governance principle, and then you talk about accountability. Again, I'm just giving a flavor of how you need to think. when you're reading the standard. So you can advise the working group that perhaps you need to put responsibility first as a governance principle, and then talk about accountability. So let's talk about responsibility. 6H, and the institution will identify the various organs of governance and management of for investment account holders, investment accounts, and assign clear roles and responsibilities to each of these organs, and also ensures that they function accordingly. Yeah. Now we go back to 60, accountability. Is it possible for you to sit and control? Because
He's doing some other control, hands doing some other control, people do that, it's a data.
okay. 6D is accountability. Obviously, after assigning responsibilities to those organs, they will then be held accountable for their respective responsibilities. 6E is risk management. Institution will have a sound risk management system, and they also need to have a sound internal control framework, especially Sharia compliance controls. 6G is transparency and disclosure. Institution will disclose all material information to investment account holders in a transparent and timely manner, so that investment account holders can make informed decisions about their investments. I'm not reading directly from the standard itself. I'm just trying to explain the core essence of it. Okay. But if you feel that the wording of a certain paragraph is ambiguous and it needs to be better written, just let me know. 6H is responsibility. We have already covered, so 6H we are not going to cover. 6I is investment strategy. And the institution will have a Sharia compliant investment strategy. But having a strategy is not enough. You also need to have the implementation mechanism in place for the strategy as well. 6J is proportionality principle. This is important because not all institutions are made equal. They differ in nature, in the scale, complexity, risk profile, and products that they offer. So the requirements of this standard will be customized accordingly. 6K is to do with the code of ethics and conduct. An institution has to adopt a relevant code of ethics and conduct to ensure that ethical compliance is also there in addition to Sharia compliance. So these are the 11 core principles for the effective governance of investment accounts. Now, Para 7. Para 7 is basically a special consideration or additional consideration for high-risk investment accounts, and we're just emphasizing that these two principles, transparency and disclosure and investment strategy, has to be further tailored, designed, and customized when we are talking about HRIAs, because this situation is different compared to LRIAs, low-risk investment accounts. That's it. Now the organs of investment and organs of governance and management, Para 8. Now here in Part A of the standard, we are only identifying the organs of governance and management, and that these organs shall be responsible and accountable for compliance with the requirements of the standard and other relevant standards. But in Part B of the standards, so this is Part A, Part B of the standards, we will be establishing the roles and responsibilities for these organs as well. So there are 4 organs with one additional organ for special case scenarios. The first is TCWG. Who knows what TCWG stands for? Those charged with governance. But who are those charged with governance? Board of Directors and the committees of Board of Directors. Excellent. So they are the first organ responsible for the governance and management of investment accounts. We have SSBs, Sharia Supervisory Board. We have management, and this comprises the senior management, the management committees, the compliance department, risk management department, and Sharia compliance department. All of this constitutes as management, and they will be responsible within their respective mandates, and external auditors as well. Now, there are some jurisdictions which require ESA. What is ESA? We have a standard on ESA as well, by the way. External Sharia audit. Yeah. So if the jurisdiction require ESA, then ESA will also become one of the organ. Part B of the standard, investment account strategy and policy framework. And if you recall, I said that as an institution offering investment accounts, you cannot go out in the public, solicit funds unless you have this all important document in place. So broadly speaking, this framework, it has to be in compliance with, number one, the requirements of the standard. It cannot go in contradiction with one of the requirements of the standard. You cannot have a framework and say, these 10 requirements of the standard we disagree with and we disregard. This is not possible. You have to be compliant with all the requirements of the standard. Then relevant regulatory requirements. Whatever is coming from DAB, you have to take into consideration when developing the standard as well. And then obviously Sharia principles and rules. You cannot be in contradiction with Sharia principles and rules. That was para 11. Para 12 is that this document has to be developed by who, by the way? Who is supposed to develop this document? DAB. DAB will develop the framework for the institution. No. The institution has to develop, but within the institution. So, for example, we have 5 different institutions. Each of them will have their own framework. The strategy and policy framework I'm talking about, because they will have different products. They will have different Sharia compliant underlying assets. Their strategy for investment might be different. Their expected profit rate might be different. Their weightages will be different. So each will have their own document. But what I'm asking is who's going to develop it, who's going to review it or vet it, and who's going to sign it off within the organs that we have identified. Those charged with governance, they will develop this framework.
They will buy the management, you would buy the board and you will buy it.
Yes, it has to be developed. See, board of directors, they don't do anything. They tell you what to do. They are never going to develop a document for you. They'll just tell you, okay, this is what needs to be written. So it has to be developed by the management. It has to be vetted and approved by the Sharia board, but then the final sign-off has to be from TCWF, those charged with governance. Okay? This has to be the process, because you can, as a management, you can have this framework and then go out in the market and start soliciting funds. This is not allowed. You have to get necessary approvals from relevant organs of the framework as well. Not the framework, the governance and management of investment accounts. Now, in this document, we have also said that in this document, the institution must promote 8 RIAs in addition to LRIAs as well. So this is something that they must focus on in this document. Now we talk about the components of investment strategy and the significant considerations of the requirements that you must fulfill in each of these components. So component number 1, this is para 16. This is solicitation of funds for investment accounts and respective prerequisites for it. So again, this is talking about the minimum requirements before launching a public solicitation of funds for investment accounts. So the first thing is ensure full compliance with the requirements of this standard. And in particular, you need to refer to Part B and Part C of the standard. 16C, 16B and C.
14.
Go to 16. Yes, I'm talking about this. I've skipped some of the sections where we're talking about just listing the headings of the components and going directly to the components. So we're talking about 16, para 16. Okay, so B and C is that the product that you are going to offer needs to be approved by Sharia Supervisory Board and the Regulatory and Supervisory Authority. 16D is that you need to make arrangements for co-mingling of institutions' equity and identify and segregate underlying assets of the investment pools. Component 2, para 17, risk management policy. Now, this is an important point. What we do is we cut, copy, paste of what we get from the conventional bank and we use it for Islamic bank. But risk management will not work this way because Islamic bank have some unique risks that need to be addressed and catered. So the risk management policy that you're going to develop has to be in line with Sharia principles and rules. Obviously, you can cut, copy, paste, but then also make sure that it's compliant with Sharia principles and rules. It needs to be in compliance with the requirements of the standard, needs to be in compliance with regulatory, regulatory requirements and the best global practices. So in this standard, which institution are we referring to as the best global practices? No, AAOIFI is developing the standard, but we are saying, okay, in addition to the requirements of this standard, you also refer to the requirements of another set of body to the best practices in the industry, IFSB standard. So we're trying to create a link between AAOIFI and IFSB. You don't want to work in silos separately. So they refer to AAOIFI, we refer to IFSB. So IFSB, as Brother Siddiq mentioned, that they develop standards on the prudential side, risk management side. So obviously, if you're like developing standards for Islamic risk management, you have to take into consideration. Risk management is not a mandate, so we don't provide guidance on risk management. It's a mandate of IFSB. Para 18. Sorry? IFSB actually makes Basel standards Sharia compliant. This is their mandate. Para 18. Now, this policy has to discuss three very important risks, which is rate of return risk, displaced commercial risk, and fiduciary risk. Para 19, we are saying that for all of these risks identified, you need to explain how you will manage it. Okay, I'll not go into the details of A, B, C, D. Para 20, the institution has also needs to specify how they are going to, basically the approach that they are going to take in managing these risks, DCR risk in particular, and profit smoothing techniques. How you're going to approach this? How you're going to manage this out? So this was risk management. These are some of the requirements that you need to have in place when you're developing a policy for risk management. Okay. Now we move on to component 3, which is about creation of investment pools and identification and segregation of funds and assets. Exactly. This is para 21. So these are the minimum requirements when creating investment pools. So is anybody here experienced in creation of pools, profit and loss computation? Anybody who's done it? Okay, mashallah. Anybody else? You? Okay, okay. So these are some of the requirements that you need to fulfill when creating investment pools. Number 1 is you need to keep minimum number of investment pools. You do not necessarily have to have 100 pools. Okay, the lesser the number is, the better for you is and for the industry is. Yes.
Why should you be many pools, more than 1 pool?
Okay, so if you increase the number of pools, number of investment pools, complexities around transfer of assets between these two pools and the tangibility criteria. I'm sure you are aware of tangibility criteria when you are redeeming your investment, you're selling assets and everything. This might result in Sharia non-compliance risk.
No, that is okay.
Okay.
There should be only 1 pool. For example,
Yeah, this is what the standard is saying, but I think it's not making mandatory. If you quickly read the para itself, insofar as practicable, as far as possible, have only 1 pool. This is what it's saying, right? Kept at a minimum. So kept at a minimum means 1, 2 pools, not more than that. But some institutions, they have 20 pools. But the standard is saying if you can actually justify having 20 pools, you can have 20 pools. We're not prohibiting, we're not keeping a cap that you cannot have more than 3 pools, 5 pools, 10 pools. Okay, so there is some flexibility, but you need to justify. And obviously it has to come through the Sharia Supervisory Board. They need to be taken into confidence. They need to approve the fact that you're having like 10 investment pools.
From technical side, there is no issue of having only one pool.
Yeah.
But because of many other objectives, banks are management is specializing to have more than one pool. So the objective is that if the banks are working with only one pool, then why we are creating more than one pool? From critical side, banks have no issue in having only one pool.
Yeah, but the standard is saying that insofar as possible, practicable, have minimum number of pools. So this is what the recommendation is, what you are saying, one pool. But the question is, do you want us to put a limit to it? This is the question. Now, your suggestion would be to AOP, put a limit, not more than two investment pools. So this could be your comment, but we are being flexible. We say have insofar as practicable minimum number of pools, but you can have more as long as you take SSP into confidence. You can justify.
No, I was there is in Afghanistan, is it should be viable to issue circular that there should be only one pool in the banks, for example, Common Mudaraba pool, or only one pool, for example, Okala pool.
Got your point. So the question is basically RSA, can they issue a circular and say we limit the number
Yes.
of pools to one?
Yes.
Okay, we'll take it to the working group. They will decide what to do with your comment.
Can I add this? Can I add something?
Yeah, please.
Why, actually, in pool management, we need more than one pool, considering the demand of the account holder. Sometimes, some account holder comes to the bank for a short period. So you cannot cover that in the general pool, like the general pool is for a month, in the short, the customer is there just for a week or about less than a month. Or sometimes specification like restricted Mudaraba is there, so the customer is demanding to take their particular asset with that investor, not every asset with that one. So then customer demand is playing role in that one, and then the management is demanding for more than one pool.
Actually, the nature of the contract, the terms and condition of the contract, that will also decide how many pools that you need to have. Because you cannot have one pool where you have completely different terms and conditions for different set of investment account holders. So anyway, I don't want to engage in a discussion of what's the right approach, but I take your comment that is it possible for RSA of a country to limit the number of pools to one?
Yes.
So
No, based on the nature of the contract, we can have more than one pool, no issue with that. For example, one Wakala pool, Mudaraba pool, Sharaka pool, this is not the issue.
okay.
The issue that we have observed in practice that, for example, in Mudaraba pool, if we are getting another Mudaraba pool, special Mudaraba pool, based on the demand of the customer, we are transferring the assets having good returns from the common Mudaraba pool to the special pools. So the common Mudaraba pool people are general people, they are not asking, they generally have discussion with banks. So good customers having high deposits are given high returns.
Can you please speak in the mic?
The recommendation here would be you need to set certain policies in respect to the pool and for your licensees to follow.
Noted. By the way, this standard discourages short-term and time-bound investment pools. It doesn't prohibit it, but it discourages having time-bound and short-term pools. Unless, of course, the institution can make a very strong case for it. If they can justify doing something that they can, and SSB is on board, TCWF is on board, then it's good to go. There's no problem. Point C. Okay. So define the roles and responsibilities of individuals or departments involved in creating and managing a new investment pool. It's pretty simple, straightforward. Point D is RIA, restricted investment accounts, should be appropriately ring-fenced and not mixed up and commingled. And this is based on the nature of RIA itself, which requires investment in a specific asset or a specific pool of assets. So each RIA must be in accordance to their respective mandate, actually. Point E is more or less the same but applicable for HRIAs. So earlier we were talking about RIAs. Point F is you're controlling now. Okay. So each pool must be considered fully segregated virtual reporting entity. This is a requirement of the standard that each pool must be considered fully segregated virtual entity. And this is a very important point and it needs to be done. But some institutions, in fact, many institutions will find this difficult because of the fact that IT infrastructure might not support it. Nevertheless, this is an important requirement of the standard. Para 22, when you create a pool, you need to have some document for it, like the investment pool creation memorandum. Yeah, it's mentioned here. Again, in this document, you need to address these 6-7 points. The first is that you clearly identify the assets which will form the basis of the investment pool. Second is you need to clearly identify the risk tolerance of investment account holders and the risk profile of investment assets, underlying assets, which could be classified as either low risk investment accounts or high risk investment accounts. Then point C is you need to define the planned duration or tenure of the investment pool. So for example, if it's a time bound pool, it clearly has an end date, a maturity date, an expiry date. Or you could have an ongoing investment pool which has no expiry date or predefined ending date. Please don't forget that the standard actually discourages use of time-bound investment pools. Point D is that you need to identify the sources of income within the investment pool. Point E, you need to identify the contract governing the investment pool and the key terms and conditions pertaining to that contract. Point F is you need to provide overview of how profits and losses will be calculated and distributed. This includes discussion of PSRs, profit sharing ratios, weightages, and any process of making adjustments to PSRs and weightages also needs to be properly specified and defined. Any limits or restrictions on PSRs and weightages have to be defined as well. Any expectation of HIBA disbursements and any limitations or restrictions on the disbursement of HIBA also needs to be specified in this document that you're talking about when you're creating an investment pool, and the creation of reserves, IRR and PER. Anybody knows what IRR and PER risk reserves are? Not returns. Reserve, yes, exactly. Point G is establish accounting policies specific to investment pools, such as provisions for impairment and credit losses, treatment of fair value gains and losses, and other adjustments to ensure accurate and timely financial reporting. Point H is about the currency of the investment pool, and this is perhaps one of the most important points as well. You need to establish the currency of the investment pool in which it's going to operate and outline the translation process from one currency to the other currency when the need arises. Now, what happens is that when you have multiple currencies, there is a risk of Sharia non-compliance happening. In some countries where the currency is not pegged to US dollar, there might be huge fluctuations. And because of these huge fluctuations, you might end up guaranteeing the capital, which is a big no-no. You cannot guarantee capital. So when you are dealing with multiple currencies, like fixing an exchange rate might lead to guaranteeing the capital. This is something that you cannot do. So when you're dealing with multiple currencies, please have in mind how you're going to manage it, what is the translation process behind it, and so on and so forth to avoid Sharia non-compliance risk. Point I, okay. It's about commingling of various sources of capital. So you have owner's equity, and this includes the share capital and the reserves, etc., with other funds under disposal, like the current account funds based on current and even Murabaha, Tawarruk, and Salam, and other participatory stakeholder funds and specific contractual arrangements that you have, like your commingling Wakala bil Istismar funds with Muzarba. Point J is about liquidation mechanism, foreign investment pool, especially if it's time bound. Now, the two questions that you need to address in your document is that what will be the mechanism for transferring assets from one pool to another? And the second is what will be the pricing? At what price are you going to transfer one asset to another investment pool? Are you guys tired, by the way? Sure. I mean, I know you are not tired, but what about the others?
Let me have some questions in the end of the session.
Yeah, so we have only 45 minutes left, and this standard will not be covered for sure. I don't want to skip any paragraph because if you have comments, then we might not be able to take it, but nevertheless.
Let me ask this question about the reserves. And so there's probably no absolute clear Sharia ground for the reserves. Investment account, investment
from world of وزع
risk reserves and
الوزع يقول وزع في القرآن 5 مرات
equalization reserves.
هذه الروابط.
Some of the investment account holders may subsidize others. It can be the cost of others, especially the short-term investment account holders. So there are some ethical issues. How the UAE can address these issues?
Is it noted how AOP is addressing this intergenerational issues where one group of investment account holders are subsidizing the other set of group of investment account holders? So this is from the governance perspective or the Sharia perspective, or both? Both.
With respect to the underlying transaction of the creation of PR in Iraq, that should be fine.
Actually, from the Sharia perspective, and you can correct me if I'm wrong, you get consent from the investment account holders that you're going to do this in the contract.
Underlying transaction, I mean, it is walk-up, or it is charity, or it is something like that. So if you define the underlying transaction, then the rules are supposed to be made according to the structure and the nature of the underlying.
Component number 4, commingling of funds. Again, this is a very important topic, and the core governance principles at stake here is transparency, fairness, stakeholder protection, because these are the principles we talk about that we need to promote, like transparency. So if you're commingling of funds, how are you going to ensure transparency and fairness and stakeholder protection and so on and so forth? So paragraph 23 and 24, I'll combine it together. Okay, so commingling of institution funds with investment account holders funds in an investment pool is optional, but if you do it, then there are some mandatory requirements. So we are not saying that you must commingle. You can commingle, but if you commingle, then these are the requirements that you need to fulfill. The first is that the institution must fulfill the contractual terms. So the investors' rights and interests must be protected. The second thing is you must fulfill regulatory requirements, and obviously you need to fulfill and be in compliance with Sharia principles and rules. You want to say something?
Yes.
Yeah.
In the committee conference, the journalist discussed between the bank and funds equity of bank and funds of IAs, instrument account holders. So is there any need of committing of funds of conventional banks with their Islamic banking windows?
Yeah. Okay. Okay.
Repeat the comment that there was not clear, yours is clear.
Yeah, this is why I was asking. So did we lose all the comments?
No, I'm taking it down. But
Okay.
say
Don't worry, don't worry. So your last comment was, can we commingle conventional banks' funds with funds of Islamic banks?
Windows.
Yeah. Conventional bank and Islamic bank, can we commingle funds? So this was the question. Has it been addressed by the standard book? Para 27, again, this is something which is preferred but not mandatory. What's mentioned in para 25. The preferred part is that the funds under different contracts should be kept in their own respective pools, like Muzarba funds in Muzarba pool and Wakala bil Istismar funds in Wakala bil Istismar funds and so on and so forth. But if you commingle funds from different contracts, so for example, Muzarba with Wakala bil Istismar or preference shares or Sukuk funds with common investment account funds, then what is the ruling coming from the standard? The standard is saying you can do it. But again, you have to follow certain requirements. One of the requirements is that you need to determine the terms and conditions of how these commingled funds will be managed. And this has to be approved by TCW. I mean, this is specifically mentioned, otherwise it is generally understood that whatever policy that you make, it has to be approved by TCW. But here I think it is explicitly mentioned that it needs to be, it doesn't need to be, preferably approved by TCW. The second point is that no group of stakeholders should be disadvantaged due to commingling. Commingling should be as if the parties involved were unrelated and dealing with each other at market terms or arm's length. This is very important. Third is that before commingling, take explicit permission from investment account holders that we are going to commingle your funds, so that all the parties are well aware of it and they give their consent. Para 26. This is talking about equity and what constitutes as equity. So equity constitutes the core capital, the reserves, and the accumulated profits from all activities of the institutions, and the funds obtained under various liability contracts. So for example, curve-based current accounts, funds held as security deposits or margins, where the institution, they have the permission to use the funds for specific purposes. And these are trust-based deposits and refundable upon fulfillment of contractual terms. So this is also included. Yes, please.
This is the equity funds for allocated for pool are generally the capital of the bank.
Okay, this needs to be clarified whether the equity that we are talking about
For
is it
example,
for the
capital is-
institution or for the investment pool.
for example, capital is a broad term. We have many things in capital.
Yeah.
But in pool, we should have only cash and cash equivalents.
Yeah.
That is for investment. And we may have buildings in capital. That can be.
Yes. Then liability contracts with or without
Yeah,
returns. Please.
Under emergency security deposits,
Yes.
if I'm not, so I remember that it is said in the standards that they should be deposited based on Darbar context.
Yes.
So here you.
What would be the basis of collecting these margins, right?
Yes.
This is what you're asking. So
So
it needs to be clarified here.
clarified, I think this should be included in customer accounts. We should give profits on margin accounts.
Okay.
I think it's also mentioned in standards, profit distribution standard.
Okay, retained liability also, where the contractual terms are not explicitly, where the contractual terms are not explicit. So, so this is what constitutes as equity. This is how equity has been defined here. Component number 5, priority of investment of funds. Now, the big question here is that Islamic banks, how can Islamic banks ensure that the funds belonging to investment account holders are treated fairly, equitably, and transparently, especially in terms of investment opportunities? So in case of excess liquidity, if you have money of the investment account holders and you need to decide whether you are going to invest using your own money or the investment account holder's money. So who's going to get priority? So this needs to be properly defined. This is what component 5 is talking about. You want to say
Yes.
this? Yep.
I think this should be a rule, the priority should be given to instrument account holder deposits. Because banks are Mudaraba purpose and the customer is funds for Mudaraba. And the true spirit of Mudaraba is they should, it's only Mudaraba, not participation of equity funds.
Okay.
So why should we give priority equity of the bank
Got it.
to the investment account holders?
Got it. Got it. Paras 27 and 28. You basically can have two situations where the Islamic banks give priority or they don't give priority to investment account holders. So if the institution give priority, then what should be included in the policy? You need to specify how assets are going to be identified and segregated within each investment pool so as to clarify which assets belong to the institution and which asset belongs to the investment account holders. This is the first requirement. The second is that you also need to discuss the maintenance of liquid cash within each investment pool. Is it going to be as per the institution's policy or the regulator's policy? So this will come as part of the policy that you are defining for the priority of investment of funds. Now, the other situation is that if you don't give priority or you don't give equitable treatment to investment account funds in investment decisions, or you allow for keeping of idle funds for liquidity purposes, then there are 3 requirements. The first is that you must comply with Sharia principles and rules. So I think there's a bit of flexibility that this standard is saying, is giving. It's saying that you can give priority to yourself over the investment account, but then you have to comply with three requirements. Number one, it has to be Sharia, it has to be as per Sharia principles and rules. So in other words, you have to find justification from Sharia principles and rules. Secondly, it has to comply with the contractual arrangements with investment account holders. So there might be a case where there is a condition or an agreement between the respective parties that we are not going to give you priority. And third is you have to comply with the regulatory requirements. So if the regulator DAP simply says that the priority has to be given to investment account holders come what may, then the case is closed. But from the standard itself, it's keeping it a bit open. Again, I recall that many people come to me personally and they say your standards are very difficult and very rigid and doesn't give flexibility. But when I read the standard, I think it is more than flexible. I think it's accommodating a lot of situations, not just focusing on one market. It's looking at multiple markets, multiple situations, because all institutions are not made equal, different positions. So there is a bit of flexibility. But having said that, you cannot compromise on Sharia principles and rules. So I take your comment. You're saying that as per Sharia principles and rules, the priority has to be given to investment accounts. This is the true spirit of Mudarba. So this is your comment. We'll take it to the working. Component number 6 is the determination of PSRs and weightages for distribution of profit. I think this is one of the favorite topics of all pool management experts. How you calculate weightages, how you define weightages, and then how you calculate profit and how you distribute profit. It's very interesting, by the way. There is a possibility of AAOIFI conducting a workshop on profit and loss distribution mechanism. If it does, because it has done several workshops in the past years. I don't think it is happening this year, but then inshallah, God willing, we'll send an invite to DAP and DAP can probably nominate some relevant people to that workshop, because then you will see on Excel how the calculations are done, how the profits are attributed and then distributed, and where the issues are basically. We did this in 2021, I think, and it was one of the best workshops. There were many Sharia scholars and they said, our eyes have been opened today. I don't know what we were doing before this, our eyes have been opened. Because profit and loss distribution is very complex and technical. And very few Sharia scholars actually understand what the game is. I'm using the word game, please forgive me for this, but you can understand what I'm trying to say. You can do a lot with numbers. Anyway, moving on. So para 29, these are the minimum mandatory requirements for determination of PSR and weightages. A and B, it's talking about requirements for both PSRs and weightages. And then point C will only talk about PSR. So first is that PSR and weightages must ensure a fair distribution of profits based on average balance during profit computation period. Now, this is an important term, average balance. Average balance concept is about, calculating average amount of funds in the account over a specific period. And this reflects the actual utilization of investment accounts with investment funds, because the investor is depositing money and then taking it out as well. So you have to take an average balance of it. Some jurisdictions in the past, I think 4 or 5 years back in Pakistan, they were using minimum balance as a criteria for profit and loss distribution. So anyway, there are different criteria. So the standard is saying that you have to go for average balance. Average, yes. And point B is a Sharia requirement. If there are net losses in the investment pool, then the distribution has to be based on average balance. And you have to ignore PSRs and weightages in case of losses. Okay, so this is a Sharia requirement. Yeah.
Yes, this is okay that we should ignore PSR weightages, but based on average variance is in loss.
Okay. So the comment is that instead of average balances, it could be
Yes. For profit distribution, average balance is okay. How can we take average balance in cases
for PSR only. And again, it's pretty simple, straightforward. For the sake of completion, I'll just go through it. You have to comply with regulatory requirements, expected yield of investment pool assets, and Sharia compliant benchmark rates, operational cost of investment, managing investment accounts, and other rational factors ensuring fairness among stakeholders. So these are some of the considerations that we need to take into account. PSR and weightages. So one day you have X PSR and weightage, and the next hour you have different, and then day after that you have a different. So there is instability. So you have to ensure stability. This is what point D is talking about. And it's saying that once you set the PSR and weightage for a computation period, it cannot be changed unilaterally. The institution cannot decide on itself that I'm going to change it. Any changes for the next period must be decided before it begins. And it also mentions how the changes in PSR weightages needs to be disclosed and communicated in a timely, transparent manner to all the investment account holders and other stakeholders. Para 30, can we allocate different weightages and PSRs to different classes of investment accounts within an investment pool? So this is a question mark. Do you think we can? Can we assign like different weightages and PSRs to different classes of investment accounts in the same investment pool?
Which is absolutely different, but PSR should be one.
No, this standard is saying that you can.
For example, PSR, there should be more discussion of PSR among the pool. PSR is only for bank and for customers.
Not among the pool, for each of the pool.
Yes, the bank is Mudari.
Yes, this is what the standard is saying, that yes, you can do this. But again, when it says yes, you can do this, you have to do this with these requirements. So these are some of the requirements. I think these requirements are going to be interesting, and I would invite your comments on these specific requirements. Point A is that there has to be a suitable range, minimum and maximum for each pool. But the question is, who will decide the range? The regulators. So for low risk investment account holders, the maximum shall not be more than 2.5 times the minimum weightage assigned. Do you agree with this? Actually, at AAOIFI, initially we wanted to make it 3 times, but then we reduced it to 2.5 times. And what we are saying here is that the RSA can have a more strict requirement. It cannot say that, so for example, we have kept it 2.5. Can it make it 10 times? Regulator, no. The standard is saying you can keep it less than 2.5, but you cannot increase it. So we have, tied their hands a little bit. Yes, there is flexibility. You have the authority to define what the limit is, but cannot be more than 2.5. It has to be more strict than what we are saying.
Then they will create another pool.
Okay, point B is that weightages has to be easily understandable and understood, and expressed very clearly. So it has to be like 1 time, 2 time, 2.5 times, and if it is expressed in percentages, then it has to be 100%, 150%, 200%. But weightages like 1.3575, the standard is saying you have to avoid these kind of weightages. Point C is that if different weightages are used within the same investment pool, the following points to be considered. These are the minimum requirements. Investment period basically allows for liquidity management for investments, and it also reduces the operational cost. And the institution can also take risk on long-term underlying assets. So these are the benefits of having long-term investments, and that's why you can assign higher weightages to them. So this is perfectly fine. Slightly higher weightages for higher average investments, and then slightly higher weightages for social and environmental projects and considerations, such as investments for widows, orphans, charitable organizations. So if you are getting investments for these purposes or these sources, then you can assign higher weightages to them. So this kind of discrimination, you can clearly see that this is discrimination, but such kind of discrimination based on these grounds is perfectly acceptable. Otherwise, originally we were saying it has to be fair, it has to be equitable, it has to be just, but this is not equitable. So there is discrimination, but this discrimination is allowed by the standard. Para 31.
One recommendation here that if profit payment method also be made a part of this one, because if someone is investing for a long period, even for 1 year, but he's asking for profit on monthly basis. So the management is supposed to liquidate food for him on a monthly basis, constructive liquidation over there. Then
Profit distribution
another
is
one he's asking, another one he's in the same category, investing for 1 year, but he's going to get his profit also after the maturity.
It's mentioned, a profit distribution, the criteria, the requirements, everything is mentioned as the
But
standard.
in these three, there is amount, and there is period, and there is you can say consideration to the widows or something like that.
But this section is talking about assigning different weightages and PSRs, not profit distribution at this point. Profit distribution will come later on. Just asking the question, can we assign different weightages? Can we assign PSRs based on certain criteria? So this is what it's saying. And then what is the limit? What is the extent? What is the difference between low and high and too high? Like, for example, I talked about like 2.5, it has to be not more than 2.5, it has to be less than. So these are the things we are talking about. What you're talking about, profit distribution, right? How it is going to be distributed, at what time it is going to be distributed.
Talking about that if you are designing a parameters for assigning a weightages, so you have mentioned there in the standard that 3 parameters can be considered: duration, amount, and
Okay.
so I'm proposing that.
Okay. Now I get it.
The method of profit
Okay.
payment may also be considered.
Got it. The point is that we talked about 2 things, the amount and the time. You are saying that we should have another criteria, which is the time when the profit is being paid.
Yes.
Right? This is what your point is. Okay, taken into account. Para number 31 talks about the minimum requirements related to Mudarif share in each investment pool. So first of all, the Mudarif share has to be fixed and disclosed before the PLC period. You know what PLC period is? Profit and loss computation, yes. Before the PLC period starts. And then any voluntary reduction in Mudarif share during or after the PLC period, at the end of the PLC period, there are certain requirements that need to be fulfilled. And these requirements relate to HIBA. Okay, and these are covered separately in 43 and 44 paragraphs. We'll discuss when we get there, inshallah. And point C is regarding the maximum limit on Muzarif's share. Now, the first right to define what the maximum limit on Muzarif share is with that, yes, with the regulator. Now, if the regulator doesn't define it, then what?
The board is to take care of the.
Exactly.
the board.
Then the institution will define it and then disclose it and communicate it to everybody. However, is there a limit defined by AAOIFI in the standard?
Does not be more than 50.
Yes, it cannot be more than 5. And it has to be disclosed for sure. Whatever the PSR is, you have to disclose. Sorry, Muzarif share is, you have to disclose. It cannot be more than 50. So we are keeping a cap now. The standard is bringing this very important requirement. The cap is 50. Because remember in the beginning, I said they take 100% of your money and then 90% of your profits. And they give 10% to all of you like charity. But is this appropriate? This is not appropriate. And then you have to suffer losses. Exactly. Very good point. Para 32. This talks about the profit calculation and distribution process flow. And this is going to be defined in Appendix C. The Appendix C is empty right now, but we are going to talk about the process flow itself. It's going to help the industry immensely. Inshallah. Point number 33, there are specific considerations for high-risk investment accounts. What we are saying is to the institution, encouraging them not to have different PSRs and weightages for HRI funds. You can have different PSR and weightages for low-risk investment accounts, but not for high-risk investment accounts, because of the nature of the two accounts, basically. What we want to do is we want to tag the returns to the actual performance of the asset. In low risk investment returns, the return is irrespective of what the actual performance of the underlying asset is. They define, okay, this is going to be the expected profit rate, and you get it, come what may. Through HIBA, through this reason, that reason, whatever way you get expected. In high risk investment, we want to tag your investment with the return of the I'm blank now. I'm tired. What was I saying? They want to tag the returns to the performance of the underlying asset, basically. They don't want to control it through HIBA and this kind of thing. That's why we are saying high risk investment accounts is closer to the true spirit of Islamic banking. Now, in this case, what is the limit of Muzarif share in HRIAs? It's mentioned in the standard itself, by the way. So for the other low risk, the Muzarif share is 50% and not more than that. But for high risk, what is the Muzarif share maximum? 33%. The standard is saying it cannot be more than 30%. And for RIAs, how much? It's mentioned in the standard, by the way. If you read it, it's there. 20%, exactly. So the standard is now, telling you the maximum amount, maximum share of Muzarif can, get. For low risk, it's 50. For high risk, it's 33. And for RIAs, restricted investment accounts, it's 20. Unless defined differently by RSA, but they cannot go beyond this. It has to be less. Component 7. We're still at part and 50 more minutes left. And I will not even be able to cover these components. There are 11 components. So I'm just on 7. So what do we do? Do you want to discuss a very specific areas, or maybe you have noted down your comments and you can start sharing your comments with me? For example, para 32, this is the comment. Para 40, this is the comment. I think that would be better. Please go ahead.
In movement transfer of assets between instrument pools,
Okay, component 7 that we're going to talk about now.
page number 29.
Can you have 34, para 34?
32. Okay, in transfer of assets, you have assets, different compliance rules, that these rules shall be compliant. I think there are different types of assets, for example, ijara assets, moral assets, and different assets. These assets have different returns. So can we add another rule or criteria that which type of assets shall be transferred from one pool to another? On which basis, for example, on the basis of return, on the basis of nature of contract. So this should to avoid the which we cannot benefit one pool and can can give loss to another pool. For example, an asset of high return, we generally transfer from common Mudaraba pool to a special pool. To avoid this, can we have another clause to regulate this issue?
So your question is what type of assets can be transferred
Yes.
from one pool to the other?
Yes.
This needs to be clearly defined.
Right. From Sharia perspective, maybe have an issue why you are transferring high return assets from one pool to another pool. Just for customer, but there are many other customers, we shall take care of all of them. And second thing that when we are transferring an asset from one pool to another pool, then there should be proper sale and purchase, process of sale and purchase.
Yes.
So from Sharia perspective, one person cannot be a buyer and start seller, and the other person is purchasing. This point, this is a very serious issue in transferring loans.
Got it. So when transferring asset from one pool to another, there has to be proper sale and purchase.
Yes.
One person cannot be a buyer and seller, and there have to be two parties. basically.
For in page number 32, in
Para
profit
number?
smoothing,
Para number
40.
40. Okay. Yes. Profit smoothing.
For
Yes.
profit smoothing, generally profit smoothing techniques are used for to cover the displaced commercial risk, DCR. So displaced commercial risk is generally in those constituencies or in those territories that have dual banking system. For example, conventional banking and Islamic banking. If we have low return, then the people will draw deposits and will take deposit to conventional banks. For territories that have only one Islamic banking system, full Islamic banking system, is this necessary for them? For example, we do not need to give riba to the customers. This is not to the spirit of Mudaraba. We shall give them actual profit in our customers. In Afghanistan, inshallah, we are working on this, and we are working on the true lesser spirit of Islamic banking.
Alhamdulillah. Actually, I've been talking about this matter with brother Dr. Yusuf Salim, that Afghanistan is a special country. They have decided to fully transform and transition from interest, usually riba-based system to Islamic Sharia compliant. And I just hope that you are going to be a role model for Muslim Ummah. You are going to set up the economy and the financial system that other people are going to come here and see, okay, this is how it works. So may Allah reward you and make it easy for you. It's not going to happen tomorrow.
Yes,
It takes decades. But you have set the foot in the right direction, basically. This is what all Muslim countries should be doing.
I read this regulation till this stage.
My comment is related to the transfer of asset from one pool to another. So generally, when we create a special pool, we create that for a purpose to give a high profit to those depositors or to facilitate those depositors considering their demands. So can we put restriction there that at the time of creation of new pool, these pools shall be created for the creation of new asset only? The transfer of asset from old pool or already existing pool to the new pool can be banned by this way, and that will be a kind of justice you do with those people that they have invested their money and we have created asset for them. Then why we shall transfer their asset to other people?
Correct. Any more comment from anybody? I cannot hear you, unfortunately.
As you said earlier, that the demand investment accounts are discouraged by these standards. Demand investment accounts, in which the customer they frequently withdraw from their accounts. Correct me if I'm wrong.
Time bound. Time bound.
Time bound.
Time bound.
So that is so why the this standard incorporated that accounts in the standard, because it has dual negative effect. On the bank side, it will encounter the bank with huge liquidity risk, because in Afghanistan, in most of the other Muslim countries, we do have the money markets, in which we trade in the short-term Islamic money markets, in which we trade in the short-term Islamic securities or the instrument. So that's why it will encounter the banks and the financial institutions with the liquidity risk. But on the customer side, especially most of the banks, they have a criteria. If a customer deposited his fund in an investment account, for example, Mudarib account, and he withdraw that amount before the 50 days from his account, so he will not be entitled to the profit. And these 14 days, the bank that has earned profit on that amount of the customer, bank will keep that profit with itself. They will not distribute that profit to the customer. So it's also injustice, also zulm with customer as well. Reserve and profit equalization reserve. In closed-ended fund, so it is easy because the bank they take the undertaking from the customer. The bank will, at the end of the dissolution of the fund, the bank will donate this amount of the investment risk reserve and profit equalization reserve to the charity. But in case of the open-ended fund, because it will continue for years and years, and the amount they are collected in these funds, in these reserves, and the banks are utilizing those amounts in its own operation. So when will the bank distribute that amount in the case of open-ended fund at the charity? As Dr. Sid also pointed out to this issue as well.
Any more comments?
When I read this, you mentioned that the equity commingling with the investment account holder money. So you put it there that the basic investment made by the bank and then security margin. The security margin words were there.
Yeah.
I recommend that the security margin is accepted and the framework of the deposit, it is current or saving deposit, that may be made part of the profit, or you can say for can be invested for a profit purpose. But if it is accepted on the basis of security, which is Rahan in Sharia, then that amount cannot be used. Nobody can use that fund. That is a kind of Sharia restriction that Rahan cannot be used. So that should be restricted, and maybe we may have explanation that one, that the security margin except in the framework of deposit, then it can be made part of the equity. Otherwise, not.
Yeah, this is a clarification. That's it. Okay. I don't know if anybody wants to chip in, wants to add your comments to this standard. That's it. I want to thank Allah subhanahu wa ta'ala once again, in the beginning and the end, for making all this possible. I'm so happy to be here amongst all of you, my dear brothers. Please note that after the lunch, there's going to be a workshop. I hope the room is going to be filled with people for the workshop as well. And I can assure you, the workshop is not going to be theory at all. I'm going to put on screen some scenarios and then ask you what is the ethical response in that situation. So it's going to be very attractive and engaging. You will apply ethical principles in real world scenarios and hypothetical scenarios. And you will navigate yourself from ethical difficulties and dilemmas. Secondly, if you think you know ethics, then this workshop is going to change the way you're going to see ethics. So please, I have sold it enough. I don't want a situation where nobody's in and I'm talking to the walls basically. So please don't go away. Okay. Thank you so much for listening to me. I know you all are exhausted, you're tired, mentally drained. So am I. Let's have some food and enjoy time together. Salam alaikum.
Brother, if you have any additional comments, you can email it to us at governance@iop.com. Any additional comment that you have on the ED, governance, governance, governance@iop.com. Any additional comment you have, please. Thank you so much.
Bismillahirrahmanirrahim. Just a few words before